Today, hang on to your hats. It's about to get interesting. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with distinctively Australian flavour. Today I want to give you a bit of an economic update and look at some of the data we've seen over the past month and try and build a bit of a narrative around what's actually happening, because there is a lot going on and sometimes I think the immediate is actually being misrepresented against the strategic long-term view. And economically speaking, we need to have a bit of a longer-term view, particularly at this time of year. So let's start by looking at the most recent information over the last month and try and make some sense of it. We're going to start with this chart, which just shows that the fastest rate hike in history is now. This is what the Fed has done in 2022, and it is by far the fastest hike ever. It's faster than the bond market crash of 94-95, the dot-com crash of 99 to 2000, or the 87 crash, or the financial crisis, or even the taper tantrum between 2015 and 18. That's a significant observation because, of course, there is no chance for the Fed to assess the impact of rises to date as they make the next decision. And the expectation is the markets are saying they're going to hike some more as well. So this is a big deal. The other point to make is that whilst history doesn't repeat itself, sometimes it does rhyme. And this chart just shows that the trend, if you compare the 2008-9 bear market with the 2022 correction so far, is sort of tracking. But it also makes the point that if it does follow that, we could well see an even more significant fall ahead. So anybody who thinks that the falls are over are probably kidding themselves. And just to make that a little bit more transparent, there is the so-called October effect, which shows that October is the month where markets most likely go down. It's well above most others, although September is pretty bad and November is also troublesome. But whichever way you look at it, if you compare the S&P 500 declines, and it's very clear that October is where the action will be, so expect more falls. The other point to make is that there are many people, particularly retail traders, who are now buying put options. This is actually a chart of the premiums, and you can see here that over the last few weeks, the proportion of traders who are taking put options, in other words, protecting on the downside, has gone through the roof. That's another signal that there is more trouble ahead, in my view. And also, if you look at bonds, it's interesting to see that whilst the volatility index for shares is wobbling around 31, some people will say it's got to get to 36 before we're really in serious territory, the volatility in the bonds market has gone absolutely through the roof at 148. And that's a big deal because we know that there is something up in the bonds market. And the other thing to note is that bond liquidity is also dropping as well. This is from Barclays, that shows that compared with previous, there is just less activity, market depths are lower, and that's across pretty much all tenures. So the whole question of what the bond market is doing becomes quite significant. Now, of course, the Bank of England last week made a significant impact on the market. They started, of course, in response to the UK government's tax plans, which included significant borrowing to fund tax cuts. And the IMF actually criticised that particular plan and said that the proposal was likely to increase inequality and add pressure, which will push up prices. And in response, then the Bank of England basically said that they were going to carry out temporary purchases of long-dated government bonds from the 28th of September, actually until the middle of October. And the purpose of those purchases are going to be to restore orderly market conditions. Nevertheless, they still do expect to do more quantitative tightening later, and the first gilt sale will take place now, 30th of October, rather than earlier as planned. And so I said earlier in the week, well, this could be a Lehman's moment. We'll have to see how it plays out. But this is a big deal. And basically, the Bank of England has now got their foot on the accelerator and the brake, doing quantitative easing in the short term to support long-term dated bonds and quantitative tightening later. And they're still thinking they're going to put rates up higher, and the markets are thinking that the Bank of England may have to lift rates by 1% next time. And of course, that had a significant impact on the bond market. The Bank of England was responding to a massive run-up in long-term bonds. It went from around 3.5% a few weeks ago up till at one stage more than 5%. That's a massive hike in the yield, and that represents a significant fall in the value of long-term bonds, down by 50%. And in fact, it was that fall in value that was creating the problem, particularly in the pensions market in the UK, because many pension funds had leveraged themselves into the situation where the value of their bonds were going down. They needed to meet margin calls, and the only way to meet those margin calls was to sell more bonds, which essentially dropped the price even further. That was strategically worrying, and indeed from a financial stability perspective, very concerning. That's why the Bank of England intervened. And just to give you some context here, there's £1 trillion in those long-term bonds, and the Bank of England is now thinking that it may have to spend up to £60 to £65 billion over the next little while. Put that in context, their quantitative tightening plan was £80 billion. Now, the other point to make is that words move markets, and you can see there that the pound US dollar dropped close to parity. It actually got down to about 103 and a bit. And when the Bank of England made their announcement, it moved back up to closer to 1.11, which is still down from where it was, but not quite as bad. And it just goes to show that when people start making comments which perhaps are a little bit thoughtless, markets act. And there is a bit of a terminal dilemma going on here, and it's simply this. Should central banks fight inflation and suffer market collapses? And if that leads to economic depression with millions laid off, well, fair enough. Or should they push to stabilise social order and employment with higher asset prices, but create the risk of runaway hyperinflation? As Zero Hedge said, it's difficult to do both. Of course, that's what the Bank of England is essentially trying to do, with a foot on the accelerator and the brake. Now, just talking about currencies, it's worth just noting how much the year-to-date performance against the US dollar has impacted different currencies. In fact, the Aussie dollar is down more than 10%, the British pound is down more than 20%. So we have a very, very strong US dollar. Now that, of course, is partly to do with the very high interest rates in the US, and the Fed is going to lift again. But also perhaps it's signalling something else, and that is the determined dominance of the US to have the US dollar still as the international backstop currency. But inflation is running hot wherever you look. So in the Eurozone, inflation is as high as it's been, and that's true for both core inflation and also for the overall level of inflation, and it's well above the 2% target. The US is also seeing the inflation still stubbornly high, and the latest PCE that came out just last week showed that actually it was up last month. Despite the fact that the costs of petroleum dropped significantly, it was offset by a whole lot of rising costs, including those relating to housing. And of course, in Australia, we got the first monthly update for inflation. It's a bit rough, but nevertheless, it shows that it's still pretty high. And if you look in detail, the excluding volatile items index is at 6.2, which is up again. And in fact, 6.2 is in the same sort of ballpark as the US. So anybody who thinks that we don't have an inflation problem in Australia is missing the point. RBA, please note, they're going to make a decision tomorrow, of course. And here in Australia, we have another problem, and this is one that will feed into inflation going forward, because whilst the rental statistics in the latest inflation numbers from the ABS are quite low, the forward view is much worse, because asking rents for new properties have shot up through the roof. That will lead into higher inflation into the medium term. And that's one of the reasons why US inflation stays stubbornly high, because higher rents are flowing into long-term CPI. So whilst you might see some drop thanks to a reduction in petroleum, of course in Australia we have two other issues when it comes to inflation. The first is that we've lost the recent duty cut on fuel at the pumps. And of course the Aussie dollar is down, which means that in US dollar terms we're having to pay a lot more for oil, which means that the oil prices will stay higher. So I don't see any expectation of inflation in Australia dropping back anytime soon. And that may be one of the reasons why consumer confidence is still down. This is the latest from Roy Morgan from last week, and it showed it ticked up very, very slightly. But we're still in very negative territory. And that's because, of course, people are having to spend a lot more on lots of things. Costs are going up. The latest CPI showed that the cost of vegetables was very high, for example, as well as other factors. And interestingly, the confidence index looking forward also was slightly stronger, but still in very negative territory. That would suggest that households are going to be careful. But nevertheless, retail was hot. That was the latest in the retail sales numbers, so it jumped up again. And that will put more pressure on the Reserve Bank to lift rates higher, simply because, of course, they need to take some of the heat out. So people are still spending some of those buffers, those households that have buffers, and people are also now putting more on credit to try and maintain lifestyle. Now, the rate outlook here in Australia is still pretty horrible, insofar that the expectation in the markets is that rates are going to be above 4% by the end of February 2024. Now, this was taken on the 27th of September. That was the day after the Bank of England's intervention, and that really was probably the peak, because then they were saying that in June 2023 we could see the cash rate at 4.3%. Now, a couple of days later, it came back to just over 4%. But nevertheless, the idea of the cash rate being at 4% over the next few months and into 2024 will put significant upward pressure on mortgage rates because, of course, at the moment, we have a cash rate which is in the 2s. And if it goes to the 4s, that's effectively a doubling of the cash rate. If you add about 3 to 3.5% on the cash rate, that takes you to a mortgage rate of 6 to 7%. Those are horrendously high given the large amount of credit we've got in the system, mostly in the mortgage sector. So CoreLogic released their September data today, and they reported that the National Home Value Index recorded a 1.4% decline in September. Although values continue to trend lower, the rate of decline eased from 1.6% in August. And they went on to say that the momentum in the pace of value decline was evident across most of the capital cities and broad rest of state regions, with a few exceptions. Housing value falls accelerated in Adelaide and Perth this month, but both cities continue to record only a mild reduction in values relative to the other capital cities, down minus 0.2% and minus 0.4% respectively in September. Sydney's monthly rate of decline eased from 2.3% in August to 1.8% in September. Melbourne tapered from 1.2% to 1.1%, and Brisbane falls went from 1.8% to 1.7%. Darwin remains the only capital city where housing values haven't started to trend lower, although dwelling values remain 10.1% below the previous 2014 peak. They also made the point that while the rate of declines eased in September, Sydney continues to record the largest falls, with housing values down now 9%, or $104,300 below the city's January 2022 peak. After a later peak and subsequent start to its slide, Brisbane has almost caught up, with Sydney's monthly rate of decline to be down 4.3%, or $33,600 below its June 2022 peak. The largest cumulative falls were concentrated in areas of Sydney's northern beaches, including Warringah, Pittwater and Manly, where housing values are down at least 14.5% since moving through a peak early in 2022, as well as flood-affected areas around Richmond and Tweed. And I'll just make the point here that we made another show yesterday specifically looking at home price falls in the northern beaches, and yes, there's definitely evidence of significant falls. Which then takes us to the question of where will home prices go ahead? Well, our own scenarios may give us some thoughts on that. Now, I look at the DFA scenarios and update them each time, so I run 3. The best case is that rates stay around 2.5% and fall next year, inflation eases and wages rise faster and there's no recession in Australia. That would be an ideal outcome. Probably unlikely, but perhaps the best case. There's a base case that says rates will rise to about 3.5%, and that means that mortgage rates will be in the 6 to 7%. It'll stay high through 2023, and inflation stays above target for quite a long time, perhaps until 2024, but there's no recession in Australia. There's also a worst case, which suggests that rates could rise to above 4%. And that will put mortgage rates up 7% plus, and they'll stay high into 2024 along with inflation. Wages growth stalls due to the recession here, and ultimately later rates will fall, but of course the damage will have been done in the process. And then, just to give you a bit of a sense, I've updated my house price scenarios. This is the Australian average, and you can see that in the best case, both houses and units over 3 years will be cumulatively slightly down 0.8% for houses and 0.6% for units. The base case, which is probably the most likely, shows that there is likely to be a fall of somewhere between 20 and 25% for units and houses. But the worst case, if things go really badly, is a more significant fall. And we're looking here at somewhere between 30 and 40% falls over the next 3 years. Now, of course, I'll update these as new information comes in, but that's a bit of a salutary message which suggests that property prices could fall quite a long way. And of course, that begs the question, well, how far will our markets fall? Well, as at Friday, we were at 6,460 on the ASX 200. But I have to tell you that knowing what I know about October and looking at some of the other leading indicators, I expect the markets to go down perhaps another 20% over the next little while. And certainly there is no sign of anything like a bounce at the moment. Will the RBA pivot? Will they slow? Well, they could, but if they do, they're going to be wrestling with inflation for a lot longer. And Phil Lowe the other day made the point that inflation is the number one issue to deal with. And finally, just to remind you that the RBA and the Treasury, of course, is living in the world of funny money. The RBA has a negative equity at the moment because of the fact that they took significant hits from their bond purchases. And of course, those bond purchases have now moved dramatically thanks to the movements in bond prices. And this was an information set before the latest bond price movement. So it could well be that the RBA negative equity is even worse. Now, of course, the question you've got to ask is, does it matter if the RBA has negative equity? At one level, probably not, because it's offset by a paper gain in another part of the government, in Treasury, so ultimately they'll net out over the long term. But nevertheless, it shows you that the RBA made massive mistakes. It's made mistakes with regard to taking interest rates too low. I think they did too much in terms of the yield curve control and buying too many bonds. And I also think that the term funding facility was nuts. Remember, that was the very cheap money given to the banks. And at the moment, the RBA is still having to pay the banks the 2 to 3% on the term funding facility money that's sitting at the central bank. That's nuts too. There are things the RBA could do, but they won't. And so we have a bank in negative equity. In other words, if they were a commercial entity, they would be insolvent. But because it's funny money, it's not that serious. And the RBA has said over the long term, she'll be right. But it does show you how far the RBA is from thinking commercially about what it does. And that, for me, is a big problem. So if I stand back and think about all of this, I think there are 3 observations. The first is that inflation is certainly not dead, and the central banks around the world are absolutely trying to drive inflation out of the system. Nevertheless, there will be events that will create concerns, and I wouldn't be surprised to see some quantitative easing going on in some parts of the system, like the Bank of England did. But it won't be the same broad base that we saw previously. It'll be point specific. And we could actually see the situation where there is more quantitative easing done to fix financial stability risk issues within the financial system, whilst at the same time continuing to lift interest rates. Those two things don't necessarily always go in the same direction, but it may well be that we get some of both at the same time. But thirdly, it's quite clear to me that ultimately the quantitative easing cycle will definitely come to an end, and the quantitative tightening cycle will continue. And of course, the Federal Reserve has said that they don't quite know the implications of quantitative tightening. The Federal Reserve has also said that they are not concerned if equity prices drop. and neither are they concerned if property prices drop. They think they are necessary evils, and they also made the point that unemployment is going to rise because that's a sign of a more balanced economy. Now, I think you can read across that into Australia. I think it's highly unlikely that the RBA here is going to be able to turn itself around and start cutting rates, or even perhaps pausing, simply because inflation is burning hot at the moment and there is really no indication of it easing. And while a lot of local commentators are arguing that the RBA is fully aware of the impact of dropping house prices, the fact of the matter is that they have other issues that they've got to deal with. And I suspect they'll echo what the Federal Reserve has said, which is that some correction of house prices is actually a good thing. After all, we're the most indebted nation when it comes to housing pretty much in the world, and many households are absolutely struggling. Final point to make here is that the financial stability issues that we are looking at now are very concerning. And there are some rumours that some of the investment banks, particularly overseas, are in difficulty. So I wouldn't be surprised to see other issues bobbing up over the next 2 or 3 months. Many investment banks, of course, have massive derivatives exposures, and they have also taken significant positions as to where interest rates and currencies are going. So the bottom line is this: we are in for a very bumpy ride at the moment. I expect equity markets to continue to grind lower over the next few months, and I also think that the shenanigans in the bond markets are not over yet. And that means that we have to expect home prices to continue to fall, values in equity continue to fall, and by the way, the crypto market will also come out in sympathy. So, batten down the hatches, and the next few weeks will be a wild ride. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer.